Well, welcome back to the iWealth podcast. 26 is here, guys. So we're going to talk about Q4, or actually all of last year, kind of, with regards to the markets and kind of what's going on, so our clients are better informed of what's happening. So I'm with Shawn Pomeroy and JP, a part of the iWealth team that are advisors. So let's jump into this. Last year, just a couple notes that I have in front of me. U.S. stock funds were up 12.8%. That's kind of an average of everything. And then we had a double-digit gains for the third straight year in the S&P 500. So, I mean, it's pretty easy to look good sitting here today with the markets. If you're going to take credit while they're going up, you better take credit while they're going down.
Because we got to keep patting ourselves.
Exactly. But JP, we'll start with you. Like, what are some of the numbers that stand out to you when you think of Q4 or last year in general?
Yeah, S&P, 500 large cap U.S. stocks finished up 18%. And maybe one of the first years in a while that I can remember where it was actually outperformed from an international standpoint. Emerging markets was up 34%, and then the EAFE index was up 32%. So almost double the return of the S&P in international markets, but had a strong year in munis. Preparing for this, I took a look back on our Q4 2024. We predicted bond returns right around 7%, or Brad, you did. Bond returns were right at 7%.
Guess,
yeah, muni bonds actually were at right around 5%. So pretty close yield, with munis being tax-free federally or tax-free state if you're in the state.
Yeah, if you do that adjustment, that's a big win.
Mm-hmm. Yeah, it was a really good year. Shawn, what are some things that stood out to you?
First time in a while that all asset classes performed well. Everything was positive, right? So all ships floated a little better last year. Yeah. And I think what was really interesting to me was it's the news cycle again, right? Why did the markets perform well when we had tariffs announced early in the year and the resilience of our economy to keep growing? I just think that it's one of those where you've got to separate the news from your financial plan.
Yeah, and it's always been that way, and it's even more so now with what's going on with other countries and things like that. It's interesting that when you Fed lowering interest rates 3 times last year,
really in Q4.
Yeah, and you really didn't see any movement with 30-year mortgages. Like the 10-year hasn't moved much. For taxable bonds being up about 7, which is a great year. What people have already forgotten, here we are in January of 2026, they forgot that we were almost in bear market last year. We're down 19% when the tariffs were announced last year. And so, all hell's going to hit the fan, like, here we go. And then all of a sudden, if you would have went away for a year and came back and you looked at your portfolio, you're like, wow, this is pretty good.
Well, and we've all got to remember that every single year, there's a spot in the year that makes you question, right? There's a period of a couple weeks or a couple months that, just the normal ebbs and flows of the market, we're down on average 14, 15%. This one, it always feels different. Is it ever different? No. It just feels different because you're living.
The scary part is if you sell during during that April pullback, you're down the 12 to 18% that you talked about, and then you miss out on, we just talked about how, the average stock portfolio was up 12, S&P 500 up 18. Those are compounding returns, so you're down. You're missing out on a big number.
Yeah.
Well, and nothing's changed. 10-year rolling averages. You look at the S&P, which I would argue is not the greatest reflection of everything going on, but it's the easiest one for us to all see. 10-year rolling returns, 10.6%. If you're not going to spend all your money tomorrow, you can outlast it.
If you don't, and so the key point is outspending. So I had a conversation this week with a client and was just going to retire and had saved a nice portfolio. And the question was, we have more than what we thought we were going to have, but I don't know what to do with it. And my point to this person that was now in his early 60s, that was going to retire, was, listen, all that mattered between now and back when you started your 401k is average returns. 8%, 10.6%, whatever. But you retire, then sequence of returns, which we know well because all 3 of us educate our clients about it. But the first 5 years out of retirement, if you have to sell stocks that are down, when they're down 19%, you're in trouble. And so some advice I had was, we need to park 2 to 3 years of short-term instruments so that if the market goes down, you've got the ability to take some money out. So
not glamorous,
right,
but works.
But to JP's point, like if you sell, you're in trouble. If you don't have to sell, to your point, then you get 10.6 on an average. So you need to make sure that you have your account set up correctly so that you don't have to sell in those time periods.
My bills don't change in April from March, right? Even though the market goes down, I still got the same monthly expense.
Right.
More shares.
Exactly.
Well, in Minnesota, they might. I mean, your dues, you're going to be playing more golf or something like that, so it might go up. You know, a couple other numbers that were interesting. Gold was up 64% last year. Silver was up 140%. We did some podcasts about gold, and we don't need to, get into should you own it, shouldn't you own it. It's really a personal preference. We know that the market long term has outperformed gold, but there's times in periods in the investment world where gold does outperform, and it had a really, really good year last year. Does that continue? I don't know.
Right, and should you go all in or just have it as a piece in your portfolio?
Back to diversification.
Yep.
Yeah. JP, I'm gonna put you on the spot. Any idea? Because I'm guessing you don't know this number. Do you know what Bitcoin did last year for a return?
I do not know. I know it went up
it went way up,
heck
right?
of a lot,
right?
And then
so Trump gets elected, all this stuff is going on, right? And the market and all this, down 6% last year. So you would have thought with everything going on, with what was happening and all the news with Bitcoin and crypto and all that stuff, it was down 6%. So
well, how about a president signing a piece of legislation or what, but all of a sudden changing the status of marijuana. Marijuana stocks should have gone through the roof, but it didn't really legalize it. It just changed its drug classification.
Sure.
And you got all sorts of people that dove into the market in penny stocks and threw a bunch of money at equities, greed. I want to get rich. This is going to be the thing. And then the rule didn't really change.
Yeah. Yeah,
and it's down.
It's like if you're betting, we should have bought some Venezuela bond paper, right? Before we went and did all this stuff. So interesting year, but overall, guys, it was a really good year. I mean, statements at the end of the quarter when you get them, if you haven't received them yet, are going to look good, that kind of thing. So then the question is, well, what do we think about next year? Like when we look at 2026, there's, some economists or some different places that we follow. What are a couple things, Shawn, that stand out to you that you're looking at for 2026?
Don't chase the best return of last year. So just because emerging markets is up the top dog of last year, that's not the time to go all in. It's the time to stay diversified, because the fact is we don't know what the catalyst is going to be that's going to change our economy. But right now, things look good. Things look like they're on a pretty decent footing to have a good year. There's going to be some headlines. Unemployment's going to go up. But is it jobs in your area that matter, or is it going to be widespread, or is it going to be focused on some people that are getting laid off because of technology taking their spot?
Yeah, and one of the economists that we talk to all the time says it needs to get above 6.5 to get to recession, and so we're in that 4 range right now with unemployment. So it'd have to be a significant jump to get there, and they don't think that we'll get there. But yeah, with AI and different things that are going on. JP, what are you thinking about for next year?
One of the drivers that they talk about, and we've really seen it these last 2 quarters, are corporate earnings growth. And the economists that we follow don't see that wavering in 2026. With the use of AI and being more efficient and things like that, they believe earnings growth for corporate America continues to be good. And typically those prices and valuations will follow that. So they've tempered expectations, right? They're not expecting another 18% on the S&P or a 20% year. But again, I feel like a broken record. There is going to be volatility. What it's based on, who knows?
Yeah. We have another election year coming up this year, the midterms. And typically this is the worst year out of the 4 from a return standpoint. So we'll see, but we do believe positive rate of returns this year, but more tempered, maybe single digits instead of double digits rates of return. Definitely volatility. The consensus is 2 to 3 rate cuts again next year from the Fed, but also the 10-year Treasury really not moving. So if you're waiting to get a lower mortgage, you might not see a lower mortgage, right? But the Fed will continue to cut. Unemployment could creep up a little bit. but productivity growth was way up fourth quarter. We just got the numbers like this week. It was way up. So maybe we're starting to finally see some gains from AI. And speaking of AI, I thought this was interesting. The spending of AI, because it seems like, Microsoft and Meta and these are all issuing bonds to pay for this AI boom that we're having, or energy that they're trying to get. The stat that I just saw is they could pay for this out of free cash flow. They're borrowing because they think it's the best thing for the shareholders. The other stat that I saw, the spending on AI is in the second inning based upon going back to Y2K and the spending that we had there. And then if you go back when computers were started to spending, like we haven't even got there yet on the money that's going to be put into AI in the future. And so I think we're on pretty good footing with AI, but you do wonder, are we spending too much money on this, or what's going to happen?
I think something key here is we've really seen AI stocks take off, and they have a lot of good news already built in. What I'm looking at and what we've heard from some of our economists is how AI starts to affect other sectors and make them more productive, which then shifts some of those returns from just AI stocks to maybe some of that broader market. And with them cutting rates, what does that do for some small cap companies? You just mentioned, the large companies are borrowing more money rather than out of free cash flow. How does that position some of those smaller companies too that don't have that huge amount of cash flow?
Yeah. One of you guys had mentioned about, I think maybe JP, about the emerging markets. So one of the firms that we're using hasn't been invested in international stocks for 8 years. They're now getting up to 9% into international. Now, they're not going into China, but they're going to Canada, Australia, UK, some other European countries, Germany, things like that. Because the price to earnings, how expensive stocks are, is a lot less expensive there. But they also believe that their growth. So if we have 2% growth here next year, which is more than we had this year, it might be 3, 4, 5% growth. So they think that growth is going to be. So I think being diversified in international stocks makes sense too. Do you guys agree with that?
I do, and I think that's a spot for active management where you've got somebody who's picking and choosing the countries that they're going to invest in and the companies inside there. A lot of it has to do with trading the money back and forth. So you got to have a smart person on that. Not all emerging countries are capitalistic.
Right.
They're just not fundamentally what you want to invest in.
Right.
And they might have great potential, but if the government's not going to let any of that money go to the people, it's not going to work. Yeah. So you need somebody who's really digging in and finding those places to invest in.
Yeah.
And that's an active manager.
Yeah, for sure. Let's talk about when somebody should reach out to you guys. What kind of life events or what type of things need to happen? Because this is good information and hopefully people grab something out of here that helps them. But when should they be seeing their financial advisor and talking to them? And there's always, divorce always comes to mind, death always comes to mind. But is there some things, JP, that you think of, like what could change where somebody's like, hey, I should talk to somebody?
And the thing that comes to mind is right away is retirement. But if you wait to come see us until retirement, then to your point that you talked about earlier, are you set up? If we all of a sudden, none of us have a crystal ball. We think that 2026 is a good year for stocks. If I plan to retire at the end of 2026 and all of a sudden it's not a great year and things are down 10% or down 15%, and I was invested 100% in stocks, I'm really looking at myself at the end of 2026 and thinking maybe I should work another year. So somewhere leading up to that retirement, whether it's planned in 5 years, planned in 10 years, those type of things are what really kind of, that's what jumps out to me right away.
Yeah. Shawn, how about you?
I'd say in addition to life events, it's just when you get nervous. It's when you have a question and you've opened your statement and you just question stuff, right? Yeah. Reach out to us. We'll get back to you as quick as we can. Do we have all the answers? No. Willing to roll up our sleeves and find out. But there's no sense in being concerned about something and not.
Yeah.
Because what we really don't want is we don't want somebody ending up making a emotional decision and going beyond the logic about what's really going on and what has their plan changed.
Yeah.
Right? Do we need to make a change? Not just the headlines.
And guys, we've been doing this long enough. We understand that there's a lot of times we sit down with clients or just people in general, and we start asking some questions just because we've been doing this long enough that they haven't even thought about asking, and being able to solve those things. That's AI can maybe help you put together a portfolio or answer a simple question about insurance. But how does that all fit in your financial plan? That's the value of working with somebody like we have with the team.
The one thing about, if I'm going to go build my AI portfolio, it doesn't consider human emotion at all, right? So think of right now, I sell my business and I get a $2 million payday. Do you mind putting that all in? AI might tell me to put that all in stocks tomorrow when we're near all-time highs, right? And how do I deal with the emotions of watching my $2 million business that I just sold and worked to build up and things like that take a 10% hit? I don't think AI does a good job of addressing the emotions that former business owner would feel about that kind of dip.
Yeah. And then how does it integrate with taxes?
Yeah.
How does it integrate with your family plan and your legal plan? All those type things. So that's great. So guys, I guess to wrap this up, 2025 was a great year. 2026 we think will be a modest but good year. We think there'll be some shifts in the market, and certainly I think we all three believe there's some volatility, because there always is. That will happen as well. So thanks for being here today. Thanks for tuning in, and if you guys need anything, always feel free to reach out to any of us on the team. We're here to help you. So have a great day.
Happy New Year.